In the last 45 years, two giant metal markets have blown up the same way, and the warning signs now forming around London's silver look disturbingly familiar. In 1980, the Hunt brothers tried to take delivery of real silver instead of rolling paper contracts. COMEX changed the rules overnight, and the price crashed 50% in a single day. In 22, big players in nickel asked for metal, not promises. The London Metal Exchange simply canceled around $12 billion worth of trades to save its key banks. Two different metals, one clear pattern. When real delivery collides with too many paper claims, the rulebook gets rewritten to protect the system, not the people inside it. Now that same four-stage pattern, hidden leverage, delivery stress, emergency fixes, and then forced cash settlement, is quietly forming around silver in London's LBMA market. If this breaks, it won't just move a price chart. It could decide who holds real metal and who is left with paper that cannot be honored. So stay with me to the end of this video, hit subscribe, like this episode, and share it to support the channel, because the full story of what may be coming for London silver is something mainstream finance does not want you to see. To understand what may be breaking in London, we have to look at how its silver plumbing really works. On paper, the LBMA looks simple. Big banks and dealers trade silver in London, and the price guides the whole world. But most of this silver is not real bars being moved. It is unallocated silver. A promise, not a specific bar. In an unallocated account, a bank says, "You own silver with us." But it does not set aside exact bars with your name on them. It works more like a bank deposit. The bank holds some real metal, then lends, leases, or sells the rest, counting on the fact that not everyone will ask for delivery at the same time. This is classic fractional reserve behavior, similar to how banks before the Great Depression promised more gold than they had in their vaults. The system looks smooth, while trust is high. Trades clear quickly, reports show huge volume, and London appears deep and liquid. But there is a quiet risk. If too many people ask for real bars, the bank must either find extra metal fast or try to settle in cash. The true ratio between claims and actual silver is not fully public. That is the first unanswered question. An odd sign is how often LBMA language stresses efficiency and liquidity, but rarely talks about hard delivery limits. It is like a water system that boasts about high pressure, while saying little about the size of the pipes. If the flow of physical silver is smaller than the flow of paper promises, then any shock in demand can expose the gap. And that silent gap is where a delivery default can begin. The first clues that London's silver system is under pressure do not appear in headlines. They show up in small numbers that do not quite fit. One of those numbers is the silver lease rate, the cost to borrow silver for a short time. In a stable market, lease rates move slowly, like a steady heartbeat. But in recent years, they have shown sudden spikes and drops, sometimes even turning sharply negative for no clear reason. A negative lease rate means lenders are almost paying others to take silver off their hands, or at least that is what the data suggests. Yet, at the same time, bullion dealers and refiners quietly report tight supplies and longer wait times for large bars. This mismatch between too much silver in the data and not enough silver in the real world is an early fracture in the vault. History shows that strange lease rates often appear before bigger breaks. In the late 1990s, gold lease rates jumped when central bank lending of gold reached its limits. That shift helped expose how much gold had been lent out and sold while the official holdings still looked untouched. The pattern is similar. Odd rates first, stress later. Another warning sign comes from delivery delays. Big buyers who once received metal in days now face weeks or are quietly asked to accept cash instead. How often is this happening, and in what size? That remains hidden. The system starts to look like a bridge with fine cracks in its support beams. From a distance, it still stands, but the strain is building, and it links back to that basic problem. Too many paper claims, too little confirmed metal. When financial systems break, they often follow old patterns. In the 1960s, the London Gold Pool tried to hold gold at $35 an ounce. Central banks in the United States and Europe quietly sold gold into the market to keep that fixed price. On the surface, all looked calm, but real buyers, especially in Europe, kept taking the metal away. Vault stocks fell while official prices stayed flat. In March 1968, the pool snapped. London had to close the gold market for several days. After that, a two-tier system appeared, an official price and a higher free market price. The center that claimed to control gold had lost its grip. That history matters now because London again sits at the center of a metal market, this time silver, where the paper price often seems too calm for the level of real demand. Today, coins, small bars, and Asian kilobars sometimes trade at strong premiums over the LBMA spot price. That gap is the modern echo of 1968. One price on the screen, another in the street. The open question is simple but serious. Is London again promising stability while its vaults slowly drain? The Hunt brothers' silver rush in 1980 adds another warning. When they're buying squeezed supply, the exchange changed its rules to liquidation only, like a casino locking the exits. The price crashed, but trust in fair dealing was damaged. The same kind of rule change, or sudden move to cash settlement, is now the hidden risk for LBMA silver. It would signal that the paper game has pushed beyond the metal that actually exists. The more we look at London, the clearer one thing becomes. Most silver there is not metal, it is paper. That paper shows up as big ETFs like SLV, forward deals with miners, swaps with funds, and quiet over-the-counter contracts. All share one idea. Instead of moving a bar, move a promise linked to a bar. This makes trading look deep and fast, but the same ounces in a vault can support several contracts at once. It is like one house used as backing for many different loans. While prices are calm and few people ask for real delivery, it feels smooth. When stress hits, many holders can find they have a claim on the same front door. Before 2008, banks did something similar with home loans. They sliced one stream of mortgage payments into many new products and sold them worldwide. When borrowers began to fail, no one knew where the real losses sat, and trust collapsed overnight. The pattern is the same. One real asset, many layers of promises stacked on top. In silver, the key question is never answered clearly. How many paper claims now sit on each ounce in London? Public reports do not give a direct number. One red flag is that daily silver trading sometimes exceeds yearly mine output. Another is that ETF shares can rise fast while reported bar lists change slowly. These may look like small details, but they link back to the earlier fractures. Behind London's calm price, more and more claims appear to be leaning on a base of metal that may not be able to support them in a delivery rush. One way to test London's strength is to watch the other main arenas for silver, COMEX in New York and the physical markets in Asia. These places act like mirrors. When their reflection no longer matches London's image, something is out of line. On COMEX, warehouse stocks and eligible metal are reported more often and in more detail than in London. In recent years, those inventories have shown strange swings, big, sudden withdrawals of good delivery bars followed by quiet rebuilds at much lower levels. At the same time, record numbers of contracts have been shifted out of COMEX and into London using exchange for physical deals, or EFPs. In theory, this lets traders move smoothly between paper in New York and metal in London. In practice, it looks more like a pressure valve being opened again and again. A past pattern helps here. Before the 2010 gold crash, tonnages of gold quietly left Western vaults and moved to China and other Asian buyers while futures prices stayed calm. Only later did the price structure change, showing who had really gained control of the metal. In silver, we now see Asian premiums jump over the LBMA price whenever stress appears. Bars and coins disappear from shelves, yet London's benchmark barely moves. The unanswered question is, how much silver has already left London for good? Without open, bar-by-bar reporting, no one outside a small circle knows. It is like watching trucks leave a warehouse at night, while the owner still claims the shelves are full. If London fails to deliver silver, the pain will not be shared equally. The first to bleed are the bullion banks that sit at the center of LBMA trading. They promise silver to miners, refiners, big funds, and industrial users. If many clients suddenly demand bars and the banks cannot find them, those banks must pay cash at a higher market price, take losses, or try to change the rules. Next in line are funds and ETFs that tell investors they have silver exposure. Some may own shares in trusts that can be settled only in cash, not in metal, if vault stocks run short. A small wording change in a prospectus or a new clause about extraordinary circumstances is a quiet red flag. It suggests someone is already thinking about a day when bars are not easy to provide. Industrial users are another weak point. Silver is vital for solar panels, electronics, and medical tools. These buyers often sign long-term supply contracts based on LBMA pricing. If the benchmark fails and prices jump, they face higher costs and may have to cut output. It is like a factory built next to a river, only to learn the water can be shut off without warning. History offers a guide. In 2008, when AIG could not honor its insurance on toxic bonds, governments stepped in because no one knew who would fail next. The same kind of chain reaction is possible if an LBMA default exposes which banks and funds have the largest hidden silver promises. The open question is who stands behind them when the music stops. If London ever fails to deliver silver, it will not stay a local story. The LBMA is the main price signal for silver worldwide. If that signal breaks, every other market must adjust, fast. A cash settlement event or a quiet rule change that blocks large delivery would be the first alarm. Prices on screens might jump, then split, as some trades follow paper quotes and others chase real metal. History shows what happens when a key benchmark loses trust. In 1971, when the United States stopped converting dollars into gold, the old fixed system snapped. Currencies began to float, and gold was quickly repriced much higher. The lesson is simple. Once a center admits it cannot honor its promises in full, the world starts searching for a new anchor. An early anomaly would likely be wild spreads between London silver, Asian spot prices, and local coinshop quotes. Traders would ask, which number is real? At the same time, investors might begin to doubt other paper claims, from metals ETFs to long-dated futures. Confidence, once cracked, spreads like a crack in glass. The unanswered question is, who steps in if LBMA silver fails? Central banks, governments, or a new group of buyers in Asia and the global south. If fresh vaults in Shanghai, Singapore, or Dubai become the new reference for real silver, financial power quietly shifts with them. Just as earlier signals hinted, a London default would do more than move one metal price. It would expose how much of the modern system rests on promises that only work as long as no one truly asks for delivery.